What's up, everybody? So in this section, we're going to talk about fake outs. Now, how do you define a fake out? A fake out is when price is consolidating and then instead of breaking to the top side, it does break up, or let's say if it's breaking to the downside and it does break down, it just goes to the opposite way from the bottom up, or it goes to the opposite way from top to the downside, right? That's basically a fake out. Now, when do fake outs happen? Why do they happen? Can you really spot them? Can you anticipate a fake out? The first things first, you cannot anticipate a fake out. It's really, really difficult to anticipate a fake out. That's like the same thing saying that, let's say you're playing soccer and you're like, okay, will this guy dodge me or will this guy fake me out? There's no way it's going to happen. You're never going to be able to fake that, anticipate that. Now, when do they happen? Fake outs normally happen after price is consolidating, right? So let's say you have a session. Let's say you have a pre-London session and you notice that price has been ranging during pre-New York, or let's say like, London Open and pre-New York, and now you're saying that, okay, like, you know what, we've been ranging since London Open and pre-New York, maybe we're going to have volume at NY Open. And at NY Open, let's say at consolidation, price breaks down and then price just goes the opposite way, right? That breakdown, that was the fake out, because price tried to move to the downside, but there was something there that made price come back in the range, and then price went the opposite way. That's the fake out. Fake outs happen all the time, right? So we need to understand this one more thing. Price will always move either up or it's going to move down. We as traders, we need to identify that what's the probability of price moving to the top side or price moving to the downside. Sometimes while price is consolidating, it's going to continue pushing bullish. And sometimes our price is ranging, it may continue to move bearish. So what we're going to do here now, we're going to pick up a few, they're basically just two variations of fake outs, right? There's a bullish fake out and there's a bearish fake out. So we're going to talk about those right now. All right. So first of all, we're going to talk about the bullish fake out, where price breaks to the top side, comes back in the range, and then starts going to the bottom side, right? So we have a resistance and we have some sort of a support down here. Right now, for example, we have a candle that's basically bullish at this point. We're bullish at this point and you're like, okay, you know what? It's perfect. The next candle goes bullish, we break out of the range. Now we've broken out of the range. Now once we've broken out of the range, we're thinking that, okay, now let's say price has been consolidating for a little while over here. Once we've broken out of the range, we're thinking that, okay, now there's a higher probability for price to continue pushing up. Now either you're looking at an impulse entry or you're looking for a retest. So let's say, for example, for simplicity, we're looking for price to retest this broken resistance. So what's going to happen is that we may see another bullish candle go up, and after this we see a bearish candle start to push down in such a manner. Now when we see a bearish candle start to push down, we're like, okay, perfect, we've broken outside of the range. Now there's a high probability for us to create some sort of a support, and then you see another bearish candle that forms at this resistance. Now after this, you see that, okay, we have a bullish candle forming at this point. Now the fake out is going to happen when there's going to be volume in the market, right? So let's say, for example, this is pre-London, or this is, London Open, or pre-New York, New York Open, NYC, whatever time of volume there is, we've studied that. You're anticipating the next candle to either break this high, or you're trying to take a buy at this point for price to go up, right? So let's say you're actually taking a trade. Now, instead of moving up, what we see is that a candle forms and it closes back inside the range. Now when you have a candle closing back side of the range, now this is going to be more prominent on a 30-minute time frame, not on the 15-minute time frame. 15-minute confirmations are weak confirmations, so I like to look at this on the 30-minute time frame, 1-hour time frame, 4-hour time frame. This also happens on a daily, weekly, stuff like that too. So let's say this is happening on the 30-minute time frame, right? You have a candle closing back in the range. Now this support, right, ideally becomes your resistance at this point. Now there are two variations this can happen at this point. Now if you're anticipating volume, there's a very, very high probability that the next candle can retest this area and then start to push down within this range. Now if you're going to trade this range, you need this range to be at least, I would say, 30 pips. This range has to be at least 30 pips for you to take this fake out trade. Now, this whole move to the top side, this is what we call a fake out, right? The reason why is that price tried to move up, right? Price broke out of consolidation. It tried to move bullish, but it closed back in the range. So when you have a prominent time frame, like a 30-minute time frame closing back in the range, after breaking out, there's a very high probability that it's going to continue pushing back down to the bottom of the range. And if there's more volume, we could also see price further dropping outside of this range and actually continuing to push down if there's more volume, right? So these things will happen. Now, the main thing to understand here is that price actually tried to break out of the range, right? This is very, very, very important. So whenever you're trading, you have to constantly talk to yourself. If you took a buy right here, right? Let's say that you took a buy right after you had a candle closing bullish, you took a buy, and like instead of price moving up, price went back in the range and closed bearish. Now your buy is nullified, right? You're getting out of that buy. You're no longer holding that buy because now you understand that, hey, maybe this move up was a fake out, right? Because now we have a candle closing back in the range, so I should better get out of that buy. And as you move along the market fluidity concepts, you start to become fluid enough to understand that, okay, maybe we're not continuing to move up, so maybe the dynamics of the direction of the market has changed. Right? It's very important for you to read the candles, right? So when price comes back in the range, this is where you're saying, okay, like, you know what? We've closed back in the range. If the next candle breaks this low, this is more discussed in the impulse entries. If the next candle breaks below this low and we have a 30 pip range, I think there's a very high probability for price to continue pushing down in the range, right? So remember I talked about there's going to be two variations. This was the first variation. Now we're going to talk about the second one. It's very important we 100% totally understand how price is moving, how price is acting for us to really take advantage of these, fake outs. Now, for example, instead of price closing like this, we have a bigger candle that closes in the range. Right? Now what's going to happen? Once we have a bigger candle closing back in the range, if you're looking for an impulse entry right here, what we talked about in ranges, in way to take a trade, whether at support or resistance, we understood that if you're trying to take a trade right here, as the next candle wicks up and starts to break the previous candle's low, is this a good entry right here? Is this a good entry in the middle of a range? Absolutely not. This is the worst possible entry you can take because essentially you're taking a sell while price is in the middle of a range. So even though if this is a 30 pip range, your tradable range is maybe like 10, 15 pips. What are you going to do with this, right? You can't do anything with this, right? Because your range is essentially smaller now, 30, let's say like 15, 10 pips, like if you factor in the spread as well, right? So it's not enough. So at this point, what's going to be much better for you to look for is for a possible retest and then a continuation down. Because if this is a 30-minute time frame, we already tried breaking up, right? Did that work? No, it didn't work, right? So there's an 80% probability now we will continue pushing down to the bottom of the range. Now, also remember, there's a low probability that price may continue pushing up. Right? We have to keep that in mind. It's not all the time the price will continue pushing down because we always talk about in probabilities. There's a very high probability we may continue pushing down. Like a lot of traders have traded these fake outs. They've been successful at it. But also there's a small possibility you have to understand that price may start to continue pushing up. Right? And also remember, one very important step. If you're trying to trade this fake out, right, and only trade and execute on the fake out if you did not execute on the buys. Now, how would you know this is a fake out? You wouldn't know. The only way you're going to trade on the fake out is that if you have missed your execution on the buy, right? For new traders, if you execute it on the buy and price comes down and you know that this is a fake out and you studied in Smart Roger concepts that this may be a fake out, don't execute on it. Just watch it play out, right? You watching how price moves, that's going to be your biggest development as a trader, 100%. Right? So always understand there has to be range for you to take a trade, right? And this candle closing down here, you have to wait for a retest. If the candle, let's say the candle closes back in the range like this now gives you enough range to take a trade, right? It gives you enough range to take a trade. And if this is a 30-minute time frame, there's a very high probability it's going to work out. Right? So this is very important. Look at these examples in the charts. In the past, you will see that there's a very high probability price has moved in the opposite direction. Now, a lot of people may know some stuff, but going over these basics, it's going to rekindle something. It's going to light up that spark or light up that bulb in your mind, and you're going to say, oh, you know what? This is something I missed, or this is something I didn't factor in while trying to trade fake outs. Now, we're going to talk about the bearish fake out in this scenario. Now, it's also true for the opposite. Let's say we have a resistance up over here and we have a support down at this point. Now, let's say, for example, we have, bearish candles that start to break down all the way from the top hand side. We're starting to break down on the bearish candles. Now, if we're starting to break down the support and you see, okay, like, you know what, there's a probability for price to go down. And now what we see in this bearish fake out is that we have a retest and candles start to print down. Instead of continuing to the bearish side, we see sometimes, a candle that forms like this, a rejection at this point. So whenever we see a rejection below a support, or let's say price started to move down and now we see some sort of rejection, there's a probability that price may do a retest at this point and then continue on pushing down. But instead, what happens is that you have a candle that instead of going down, we close back up in the range. Now, this is the opposite of what happened in the bullish fake out, right? In this bearish fake out, there was so much volume that price broke below support, right? We closed below support and we had confirmations that now we may have a retest to continue down, but instead of a retest, price closes back in the range, right? So whenever we're closing back in the range, and we do understand that this may be a 30 pip range or even like a 40 pip range based on a 15-minute time frame or 30-minute time, especially on a 30-minute time frame to a 1 hour time frame. If this is a 30 to 40 pip range, this is a perfect opportunity for price to continue pushing to the opposite direction. Because again, price tried to break down, it couldn't maintain its bearish move, so it closed back in the range. Now visually, what we're anticipating is for the next candle to wick down and continue pushing up in this range, right? This is the most simplistic form of a bearish fake out. Like whenever you have a bearish fake out, there's a very high probability the price may push in the opposite direction. And as we continue up towards the resistance area, there's another very high probability that with volume, we can continue breaking up. And this is where the trend can continue to push up. Now, another scenario in this, which happens a lot of times, is basically, let's say that we have a candle that closes within the range, right? It closes somewhere in the middle of a range. Now, whenever a candle is closing in the middle of a range, this is not the right time to probably take a trade at this point because we're closing in the middle of a range. What are you going to do in the middle of a range, right? You have to identify what probability there is for price to move up and what probability there is for price to move down. There's a 50-50 probability that price will either move up or it's going to move down. And as we've discussed in the previous lessons, that whenever you're trying to take a trade, make sure your entries are taken near to the zones, right? So in this case, there's probably, if we're following perfect price action, perfect market structure, there has to be some sort of a bearish move down. We create some sort of a support. And if there's volume, we may continue to push up. right? But this is not the ideal state to take a buy in a bearish fake out, because essentially what's happening is now your probability of price moving up comes down from 70% or 80% to maybe 60%. Right? Because if this is a 30-minute time frame, we've created a resistance at this point, right? So this is where complications happen. So whenever you're seeing a setup form, let's say a fake out setup, for me personally, I want to see something perfect formed, right? And these things also do happen. Something perfect is going to be something like this. That's it. That's all what I want to see. Because if I'm trying to take a trade at this point, on the next candle right here, my stops are below the 30-minute candle, and then I'm not expecting this new candle to break the low of the previous candle. I'm just expecting it to continue to push up. That's all what I'm expecting it to, right? Now, when it comes towards managing risk, we have to go over the risk management section. We manage risk on the 15-minute time frame, you know, when we're taking on 30-minute candle trade, and so on and so forth, right? So fake outs, they do happen. We have to see if the candle confirmations are there, and we've talked about this a lot of times too. Make sure that the trade you're executing on, or the candle setup you're executing on, is exactly how you picture in your mind, because most of the times those are the cases that do work out. All right, as simple as this sounds, it's actually that simple. The only problem is we have to just wait. We have to wait for candles to print something that we can recognize. When we can recognize the pattern, when we can recognize a certain pattern or a certain way the candle is closing for us to actually execute on a trade, then executing on that trade becomes much more easier, because we know in our mind that we've seen certain things happen over and over and over again, and also there's a higher probability for certain things to play out. But at the same time, we have to understand probabilities as well, right? Now these setups, like these setups we talked about, there's a higher probability for them to play out. There's also a lower probability they may not play out. So that's where your psychology comes into play, and we've discussed this all over again as well, that whenever you have that lower probability playing out, you have to manage risk. That's a part of trading. That's a part of your trading plan. That's a part of your risk management strategy. So whenever you're fronted with a situation where that small probability of a trade not playing out, that's when you got to mitigate risk, right? But in the higher probability, like 70% chance, 80% chance, things are playing out, and you do see fake outs happen, that's when you're going to say, okay, you know what? We're going to continue with this and we're going to execute on this. Again, fake outs, they're complicated, right? They're complicated. You can't anticipate a fake out until and unless a candle really closes in that direction, right? So in the start, what I'm going to say is just like sit back and watch on the charts how fake outs have played out. If you were able to recognize them, if you were able to anticipate them as candles close back in the range, right? Go over the previous charts, go over the 30-minute charts, 1-hour charts, and look at times of volume. Look at times when price was ranging, and during the time when price was ranging, look to see whether there was a fake out. If there was a fake out, look at the candles and really ask yourself that where could you have executed a profitable trade. Now, you're not going to get better in a week or in a month. This would take like 3-4 months of deliberate effort and deliberate practice in seeing the same things happen over and over again. Awesome. That's all for fake outs. We're going to see you in the next section. Now, this may seem very simple. Buy support, sell resistances, right? Very simple idea, but you have to understand, when are you actually trying to buy supports? When are you actually trying to buy resistances? So we're going to talk about two things. We're going to talk about trend trading, right? Trend trading, and we're going to talk about counter trend trading, and these two concepts are equally as important. So first, we're going to go over what's the trend, how you're trying to gauge market structure, how you're trying to gauge candles movements, and then we're going to talk about counter trends, because a lot of times what happens is, like, for example, price starts to rally and price is rallying, amazing, perfect. What traders like to do is they're like, okay, you know what, price is rallying, and I see a resistance to the left-hand side, and because of that resistance, we will reject that area, and then you take a sell. So when you take a sell, essentially what's happening is you're trying to take the opposite trade of a price that's moving up. Or if price is moving down, like we say, falling knives, if price is moving down, you're like, okay, you know what? I see a support. And based on what I've studied is that we're reaching a support, there's no confirmation for buys, but I see a support, and I'm going to take a buy right there. And when you take a buy right there, or you take a sell all the way up over here, price starts to rally up. or if you take a buy, price starts to keep on dropping down. And this used to happen to me as well, because we're trying to counter trend. We're trying to catch that wick trade. We're trying to catch that perfect entry to have a winning trade. So we're going to go over that. First, we're going to go over trend trading. Next, we're going to go over counter trend trading. The concept is very similar, very simple. This is why it's a smart Raja concepts, very simple concepts. But the only issue is you have to wait for the candles to print the way you should have them printed, right? So let's talk about that. All right. So what's the basics of a trend? Now, a lot of people know this as well. A lot of people have even studied this through our live streams, through our videos on YouTube, stuff like that. But it's always a good idea to go over the basic concepts, because the basic concepts are something that build your foundation, and a strong foundation is what you need to be profitable in the markets. Because guess what? Markets are not complicated. Markets are just as complicated as you're going to make them. So we're going to go over that right now. So the basics of a trend is this: price moves up, we create a high, price comes down, we make a higher high, price comes down, we make a higher high, and so on and so forth, right? That's how price moves. Now, when we're taking a look at this from a candle's perspective, right? What happens? You have a candle that prints bullish. Now you want the next candle to move up. Next candle should respect the low of the previous candle right over here. So now we have a higher low and we have a higher high. Now the next candle has to respect the low of the previous candle and continue to push up. So this is the basic idea of price moving up, making higher lows and higher highs based only on candles. Now, we're going to go into trend trading. If I can find my magic eraser right here. Okay, found it. Awesome. Now, trend trading is really simple. You identify the trend, and the way you identify the trend is basically you see where the higher time frames are moving. Now, let's say, for example, you're looking at the daily time frame, and the daily candle, you see that, we're pushing up over here. You're like, okay, daily candle has to move up. You look at the 4-hour candle, and, maybe the 4-hour candle is, somewhere situated like this. We have a candle like this. We have a 4-hour candle forming like this. And you have clean range to the left-hand side. And you're saying, okay, the 4-hour candle is also bullish because we're creating support. Okay? Now, the basic idea of trading a bullish trend is that you're waiting for price to create support. Make a note of that. To trade a bullish trend, you have to wait for price to create support. That support could be on the 4-hour time frame. That support could be on the 1-hour time frame, 30-minute time frame, 15-minute time frame supports. They are okay, but the problem with the 15-minute support is that the confirmation is weak. It's a weaker confirmation. So that's why we're looking at the, I would say ideally, the 30-minute time frame or the 1-hour time frame, right? So you have to look for supports on the 30-minute and a 1-hour time frame. Now, let's say that we are in a bullish trend, right? So we're going to remove this and we're going to draw up some proper examples right here. But this trend is also identified on the daily and the 4-hour. So if you have made up your mind that the 4-hour is bullish and there's a high probability 4-hour can move bullish, you have to wait for supports. The supports are formed on the 1-hour and 30 minutes. So let's say, for example, let's say, for example, we have a bullish candle moving up. This is a 30-minute time frame, moving up, moving up, moving up. We are moving up right here, okay? Awesome, we moved up at this point. Now, we have formed a resistance at a zone on the 30-minute time frame. Now, if you've gone through the section of zones and ranges, you may look at this and say, okay, you know what, Raja, based on that virtual class we did, price is at a 30-minute zone, and 30-minute zone is a very strong zone, so there's a higher probability it can go down. Why can't we take sells? The reason why you can't take sells at this point is because, let's say you take sells at this point in a heavy bullish trend, and you have pre-London volume, London open volume, New York open, NYC, whatever that is, but the time is when there's a lot of volume, right? So let's say you take a sell. What can happen is, if you're not focused on the trend, is that the next candle can break this high right here and continue pushing up. That's something that can happen. So whenever you have a bullish trend, you're not looking for sells. No, you're looking for buys at this point. And we're going to talk about the condition for sells as well in a bullish trend. So let's say you have like, a rejection right here at this point, and now price starts to go down. We're moving further down. We're moving further down right here. We're moving down here. And let's suppose the trend is coming all the way from the bottom, and now you have a support form, right? This is a support form. A support is formed when you have a bullish candle closing after a bearish candle, right? The only forms of supports you're looking at are in uptrends. Always remember this all the time. Trend is your friend. Don't trade in consolidation unless you have a bigger range, right? And when in a trend, wait for supports form. These supports could be in the, these supports could be a part of your 30-minute time frame, your 1 hour time frame, right? The higher the time frame, the better. But the 30-minute time frame, strong supports. Now, first things first, right? Your support is formed. You waited for the support formed in an uptrend. Perfect. You got your support formed. Now at this point, you're measuring the range, right? Let's say this range on the 30-minute is about 30 pips. You got a 30 pip range. You got a support formed, and you're like, okay, you know what? I have enough range to take a trade for price to retest this high. Now remember this one thing. Whenever we're in a trend, whenever price is in a trending market and it makes a high, there's a high probability, there's an 80% probability that that high is going to be retested. And how is that high going to be retested? If we're going to create support. So if we're creating support at this point, there's a high probability for price to continue pushing up if we're creating a support, right? And your stop is below this candle. That's it. That's all what you're looking at. It's a perfect example. This happens all the time. All the time it happens like, clockwork when there's times of volume. So whenever you have an uptrend and you're anticipating 4-hour candles to go bullish, you're anticipating the daily candles to go bullish, you're waiting for 30-minute or 1 hour to create support and to continue pushing in the trend direction. That's where you're only trading the bullish trend. Now, sometimes you can have different variations, and these variations could be like, you can have a bearish candle forming like this, and you can say that, okay, we got a bearish candle closing with a small body. This means that maybe the move pushing down, the volume of bearish candles moving down is decreasing because now you have a smaller body. Because always remember, the candle bodies are going to tell you how much volume there is in the market, right? So you have a bigger body, boom, you got a small body at this point. What are you trying to do at this point? Are you trying to wait for a support formed, or are you trying to take an impulse entry as the next candle breaks above this high without breaking this low? You're taking an impulse entry at that point, right? Because sometimes, if you're new, you're going to say, okay, I'm going to wait for the support form, and you're going to wait, and as you're waiting, candle starts to pump up at this point, and candle closes like this. And now you're like, oh man, I knew price was going to go up. How did these people take impulse entries? I don't understand this. So the more you see price move up without you being not in the trade, the more you're going to learn about impulse entries, because the more you're going to see, because when I first started about impulse entries, I would see price move against me all the time. And I would say, okay, why is price moving against me? And I'm not in that trade. How could I have been in that trade? So I'm like, okay, if trend is where price, makes a higher high and a higher low and all that stuff, and if this candle is respecting this previous candle's low, which means it's making a higher low, and if it's breaking above this high right here, this means that it's making a higher high. So if I can take an entry as it's breaking the high and have my stop below this candle or even this candle, maybe and if a trend is up and there's volume, maybe I have a higher probability of winning that trade with an impulse entry. Make sense? So that's how this whole impulse entry thing came into being, by watching price move when you're not in that trade, right? So go over these things, right? Go over this virtual class again. Now, let's say we have created a support, right? So we're going to talk about this. So let's say we've created a support right here. Let's say we've created a support right here. Now we have a support at this point. Now, okay, let me just bring this up here a little bit. And we're going to talk about counter trend trade when price is trending bullish. All right. So let's say that price is, when the trend is bullish. Okay, my bad. Let's do this, right? So from down over here, price is moving up, price is moving up, price moves up, and then boom, we have a resistance formed, and we have another resistance formed right here, bearish candle, more bearish candles coming down, like this, right? Awesome. Now, all of a sudden, we have a support formed right here. Now, if you're trying to take sells in a bullish trend, again, you have to wait for support formed, right? Now we have a support form at this point. Now, if we think that the price can go down, you have to wait for price to break support, right? In essence, you have to wait to see whether you can get a bearish candle forming like this, closing below the support, because one candle closing bullish after bearish candle, boom, you got support form. Now, if you want price to go down, you have to wait for a candle to close below support in a bearish form, and now you can anticipate the next candle to continue pushing down like this. And in this case, we're going to wait for, an impulse entry to break this low and go down, because now we're going to say that, okay, even though the trend was bullish, we created support, and support meant that price should go up. But if the next candle didn't break the high right here and it broke the low, closed below, maybe we can be fluid in the markets. That's what market fluidity is, right? Maybe we can be fluid in the markets, and we can identify that, okay, maybe we're not trying to go up now because now we've broken support. Maybe there's a high probability for price to go down. Okay, the more you see this happen, the better you're going to get at it. This is a perfect world example. There are also variations of these, right? There are a lot of variations of these. The candles can close with small bodies. The candles can close with, big bodies and stuff like that. So let's say you got a support right here, and you got a bearish candle that's closing like this, and then you can get another bearish candle that, closes like this. So then you can anticipate price to go down. And as we talked about impulse entries, you can go over that, and zones and ranges, that if let's say this candle closes away from this support, what are you going to do? Are you going to take a sell, or are you going to wait for price to retrace? Because the further away we move from a zone, what happens? The further away we move from a zone, the higher the probability of price to retrace, to retest that zone, right? So you have to wait for price to print in a way that you can understand. So if we're closing like this, then you're like, okay, you know what? There's a high probability that price can go down. And always remember, there's a lower probability we can go right back up, So you're always trying to trade when there's a higher probability, for price to continue moving. Now, this was for uptrends. Now, obviously for downtrends, it's the opposite. So we're going to go over that now. So let's say, for example, you have candles pushing down. You got a bearish candle, you got another bearish candle right here, and then you have another bearish candle. People love when price moves down, right? We love when price moves down. And then we have another bearish candle starts to move down. Beautiful. We have a nice trend going on over here. 4 hour expecting to go down. Daily is expecting to go down. You're like, awesome, perfect. This works amazing. Now, all of a sudden, you have a bullish candle forming right here. Boom. We got support formed. In a downtrend, okay? Don't forget, this is a DT, downtrend. This is a downtrend. Now, whenever you have a downtrend, and if you're trying to take a buy at this point right here, and it's a very, very volatile pair, let's say it's gold or pound yen or whatever high volatile pair you trade, and it's a downtrend, there's a possibility that if you take a buy right here, the next candle respecting this high, it can continue pushing down. You got to keep that in mind. So whenever you're trading the trend, don't fight the trend. Wait for the trend to show you some signs, right? Because having good signs is a good form of trading. So now let's say you got a support formed, next candle starts to move up, next candle starts to move up, and then we have, boom, we have a resistance form right over here. This is a 30-minute resistance. This is a 15-minute maybe, but I would say a 30-minute or a 1 hour resistance. We've gone over these situations over and over and over and over again. right? Now you have a resistance formed. There's a high probability for price to go down. Now another thing, you have to make sure that this is a tradable range. I would say like minimum 30 pip range. If this is a tradable range, you can have an easier move going down. Because whenever price makes a low, there's an 80% chance that price will retest that low. You have to wait. Whenever you have a downtrend, don't fight the trend. Don't take a buy. Wait for price to create resistance and then continue down. Now, sometimes what can even happen is that without price retracing all this way up, what can happen is that you can have, let's say, a bullish candle form, and then you can have a bearish candle form like this, right? Now what do you have? Boom, you have a resistance formed. Now, is this enough range? Well, candles with no wicks, what wicks, we already talked about that. Now, is this enough range? Do you have enough range to take a sell? Absolutely not. Now, price is just consolidating. Same thing goes for when price is trending bullish, and retraces and whatever. Bullish, retraces, create support. Yeah, right? The same thing. So at this point right here, there's no sells at this point, right? The only thing that you can do is that if a next candle, let's say we break above this resistance right here, we've broken above resistance on a 30-minute time frame, so that means we've broken above a strong zone because 30-minute zone are stronger. Now you can anticipate the next candle to correct the move that we had earlier on, which came down. So that's clean traffic to the left-hand side. Makes sense? Now this is where you can take a counter trend trade. In the same scenario, okay, now follow me right here. In the same scenario, let's say that this candle closed away from a zone. Let's remove this arrow. Let's say that this candle closed away from a zone. Can you take a buy at this point in downtrend? Absolutely not. Because we moved away from the zone. There's a high probability for it to do a retest and then potentially go up or come down, and this whole thing becomes a fake out. We've talked about fake outs as well. So whenever you're trading, you have to wait, or let's say whenever you're trading a downtrend, you have to wait for a candle to create some sort of a resistance. Now, this resistance can form with a bigger range or small range. If it forms a small range, this is maybe what, like 10 pips? What are you going to do with 10 pips? Nothing. Then it's better off to wait for price to break support or close below or give you some more confirmations that we can continue to push down. But again, if you're trading counter trend in a downtrend, you have to wait for price to break resistance. No, form resistance first and then break resistance. So if we break above this area, then you can say, okay, you know what, maybe now we can correct that move. Okay? Now we have to go over this again. Go over this class again, this virtual class. These are very basic concepts. These situations do occur in the markets, and the more you familiarize yourself with these concepts, only in times of volume, they will play out in your favor more often than they're not going to play out in your favor. All right, so trend trading, as simple as it may seem, it really is that simple. But the main idea is you have to wait for candles to print in a way that you can recognize for you to take a trade. So we're going to go over that again. If you're trading an uptrend, you have to wait for support to form. If you have a support form, then you can take a look at how the support is formed. Has the candle closed, a big body candle, small body candle, a bearish or bullish, whatever that is, but the support is formed. If you're trying to sell in a downtrend, you have to wait for support form, and then you have to wait for support to break with confirmation. Same thing goes for downtrends. If you're trading downtrends, you have to wait for a resistance to form, right? If you formed a resistance, then you have to wait to see if you have any, candle confirmations, candle closing bearish for you to take a sell. And if you really want to sell, or if you really want to buy in a counter trend when it's moving down, you have to wait for resistance to break. Right? The only way you're waiting for a resistance to break is in a downtrend to maybe correct that move up. Or the only way that you're waiting for support to break is in an uptrend to correct that move down. Right? Important concept. Go over this virtual class again, maybe 3 or 4 times. Some of you may already know these things, but it's always a good idea to go over these simple concepts, because sometimes we miss certain things. Sometimes we ignore certain things, and that one quick thing can light up a bulb in our head, and I'm like, oh yeah, you know what? That actually made sense. That really did make sense. So good luck. look for these situations in the charts only in times of volume. You know, you got your pre-London, London Open, pre-New York, New York Open. Well, pre-New York volume has shifted a little bit, you know, so NYSE, London close, good luck. What's up everyone, welcome to another episode of Smart Raja Concepts. Now, today we're going to talk about impulse entries. Now, before we get into the impulse entries and the candle confirmations and all that stuff, let me talk to you about how basically this whole idea of impulse entries came in, right? So now, in the beginning, we're basically told that you have to wait for candles to close, you have to wait for candle confirmations, whether it's outside of a zone or when it's creating a support, you have to wait for a candle to close. Once the candle closes, that's your confirmation. Then take a buy or take a sell, and price is most likely to go up or most likely to go down. We all know there are probabilities, right? There's a probability price is going to move up. There's a probability price is going to move down. Now, when we're looking at these things, right? When we're waiting for candles to close, whether bullish or bearish, sometimes price doesn't really give us that confirmation. Sometimes, price just continues rallying up or it continues dropping down. That happens a lot of times, and as a new trader, when we look at that, we think, oh, okay, maybe I'm missing the move right here. Maybe, maybe my strategy is wrong, or maybe I haven't aligned myself properly with the market because I was told to wait for the candle to close. And as I'm waiting for the candle to close, price is just moving where I wanted it to go. Man, I've missed the trade. Now, that used to happen to me a lot. And what I decided to do at that point was I was like, okay, that's interesting because I'm really good at executing when candles are closing. I'm really good at executing, especially with confidence as candle is closing. But what am I going to do when candle just continues moving my way? Because someone's taking that trade. Someone is in that trade profiting as price is moving, right? Whether that may be a entry before price moved, or maybe that was an entry that someone was, okay, you know what, I think price is going to go up and I'm just going to take a buy, and price goes up and price goes in their favor, and they're like, okay, you know what, yeah, I knew price was going to go up. But as traders, we need to execute with confirmations, right? So then I started to do was I was like, okay, you know what, if price goes in my favor without candle closing, how could I have executed on this trade? Now, sometimes, we can use a buy stop or a sell stop. Well, buy stops and sell stops basically mean is that once your buy stop is executed, you're anticipating price to continue moving bullish. If your sell stop is executed, you're anticipating price to continue moving bearish. Now, when impulse entries came in, so you have to look at where price is breaking the highs or the lows, because I decided that, okay, you know what, if I'm missing out a trade and price continues moving, where could I have an entry? And I spent almost 5 to 6 months just watching, not trading, just watching. I spent 5 to 6 months just watching to see how could I have executed on that trade. And then there were almost certain, very few scenarios that made sense. That, okay, maybe this is what we can do. So we're going to talk about, first we're going to talk about candles. We're going to talk about candles, the way the candles are closing and forming, types of candles. And then we're going to move into these certain scenarios that have personally worked best for me. And a lot of you guys, you've been through the market fluidity. We have 3 webinars on impulse entry in market fluidity, impulse entries 1.0, 2.0, and 3.0. You guys know that, right? But today, we're going to talk about specific scenarios that have a higher probability for price to continue where we expect it to go. So we're going to talk about that. Now, first, we need to talk about types of candles and how the candles close. Some of you may already know this, but we're going to talk about the candles once again, the whole thing, how candles close, how candles open, what they mean with wicks and without wicks. So let's take a look at this right here together. So here we have a bullish candle with no wick on the top, but it has a wick at the bottom. Next, we have a bullish candle with no wick at the bottom, but it has a wick on the top. Now, what does this mean? Usually when you have a bullish candle with no wick on the top, this means that there's no range for the next candle to go up. That's what that means. But when you have a candle with no wick at the bottom, this means that the candle closed bullish, but it had no volume to go down. It had no opportunity to even create a bearish wick. The volume was so much bullish that it couldn't even go down. It just moved up and it created a wick on the top, right? That's what this means. This right here, the candle volume was bullish, obviously. It went up, but it has no wick on the top, which means there's no range for price to continue moving up. That's what this means. Now, if we look at this from a bearish perspective, let's say now we have a bearish candle. Now the things have turned, right? Now when we take a look at the first bearish candle, the first bearish candle means that there was no bullish volume. There was zero bullish volume. The price couldn't even make a top wick, and price came down, made a lower wick at this point. Next one, we have a bearish candle, but no wick at the bottom. This also means that there was a lot of volume for price to go down, but it didn't make a range. If it didn't make a range to the downside of a bearish candle, this means there's a 50-50 probability that price is gonna continue pushing down, right? Get it? We talked about the bearish candles, and we talked about the bullish candles, candles having no wick on the top and candle having a wick on the top and the bottom at the same time. So now we're gonna talk about the scenario that I execute on and a lot of other successful traders have executed on to make profound gains from the market, right? So now, let's talk about that. For example, we have a bullish candle that goes up. Let's say we have an uptrend. We have another bullish candle that goes up. We have an uptrend. And then we have a bearish candle that closes like this with a big wick at the bottom, right? This normally means that price tried to go down, but it couldn't maintain its volume down and closed a small bearish candle. This is what this means. Whenever we have a structure like this, there's a very high probability, provided there's volume in the market, that could be in your pre-London, London Open, pre-New York, New York Open, London Close. Whenever there's volume in the market, there's a very high probability that price will break the high to continue pushing up. Right now, there are two scenarios in this situation, right? The first scenario, we're going to talk about the first one. The first scenario is that when the new candle starts, right, and it starts to break the high of this bearish candle, once it starts to break the high right here, there's a very high probability it's going to continue pushing up, right? Now, in this case, your stop losses are going to be below the previous candle wick. And I'm going to tell you why. The reason why your stop loss is going to be below this previous candle is because this candle didn't make a lower wick to continue moving up. It didn't make a lower wick to continue to move up. So whenever you're taking an impulse entry with a candle that hasn't made a lower wick, there's a higher probability it can continue pushing back down, right? It has a higher probability it can retrace and come down. So this is risky at this point. So when we talk about, okay, what's the probability of this candle continuing up versus you have a candle that made a lower wick first before going up. The candle that made a lower wick first has a higher probability it's going to continue moving to the top side. But if you have a candle that did not make a lower wick and start to go up, that has a lower probability to go up. It can still go up, but the probability of going up is a little bit lower. So when I take a look at a pattern like this, or when I take a look at, if the candles are closing in this way, when you have a bearish candle, I look at the wick to the bottom as having, let's say, a 90% chance that price is going to continue to push up. But if I see that a candle has no wick at the bottom, and it starts to break this high right here, I see that as maybe like a 70% chance that price is going to continue to push up. You see what I'm saying? So whenever you have a candle with a lower wick first, as it starts to break the high, I'm using my regular lot size. But if there's no lower wick, I'm using a smaller risk, a smaller lot size, because of the probability that it's going to go up, right? So you're keeping in mind the probability, you're keeping in mind the risk that, okay, what's the probability it's going to go up? And if there's a high probability, you're using your regular risk. If there's a lower probability, you're using a lower risk at that point. Now, let's talk about how are you anticipating the candles to form. Now, the basics of trends is that price, like, let's say you have a candle, and trend is going bullish. You have a next candle, trend is going bullish. So a normal trend is that a candle is going to respect the low and it's going to break the high. So it's going to make a higher high and it's going to make a higher low, right? Very, very simple. That's the basics of a trend. So let's say if we are expecting price in this example to continue to push up, and let's say we have the perfect scenario, and trust me, man, these perfect scenarios, they always happen, they do happen, and people execute on these. Now, the perfect scenario is whenever you have a candle forming, even though this candle starts to go up, it shouldn't break the high of the previous candle. If it doesn't break the high of the previous candle, and it starts to make a lower wick respecting this low, and once it starts to break the high of this bearish candle, then you can say, okay, you know what? This is a very high probability that price can continue to push up. Because number one, trend is bullish, right? Number two reason is because the previous candle is an exhaustion candle. An exhaustion candle is when the wick is bigger than the body. It's an exhaustion candle. And number three is that when the candle, new one, is breaking the high. Once it's breaking the high, you're like, okay, you know what? This is perfect. All what I'm going to do is I'm going to take a sell impulse entry and my stops are going to be below this current candle. And then price is going to continue pushing up. There's a 90% probability that this will continue to move up. I've executed on this a lot of times. Every time this happens, I'm like, okay, you know what? This is a higher probability for price to move, and let's execute on this. Now, second, right? Second is basically the opposite. Let's say you have a bearish candle coming down, you have another bearish candle that comes down, so we're making lower lows and lower highs, and then all of a sudden you have a candle that closes bullish like this. Now essentially we've created a support in the scenario where a candle has closed bullish, and you're like, okay, you know what, we've created a support, and maybe, oh, one thing I forgot to mention, these scenarios, they perfectly work on the 30-minute to 15-minute time frames, right? Also, they work on the 1-hour time frame. They also work on the 4-hour time frame. But as you go higher up in time frames, what you're going to realize is that the stop losses are going to get bigger, but the moves are also going to be bigger, right? It's more prominent on the 30-minute. I've executed a lot of times on the 30-minute, very, very prominent. I've executed on the 1-hour time frames as well, very, very prominent. Now, let's say you have a situation like this, right? You have a potential support formed, and let's say this is a 30-minute time frame, excuse the writing, 30-minute time frame, and you have a candle closing like this. Now, normally, when I look at this, I'm thinking about that, okay, you know what? As long as the new candle respects this high at this point, and once it breaks this low, okay. Now, back to business, right? So now let's say if the new candle, it respects this high, but once it starts to break this low, this is going to be the perfect confirmation for price to continue pushing down, right? And in this scenario, it's going to be the same exact thing. Now, what you want the new candle to move up, but to respect this high. And as it starts to break the low of the previous candle, which is a bullish candle, this means the trend is being respected because we're making a lower high and we have an opportunity for price to create a lower low, right? So when it starts to break the low, this goes in a sell mode and then price continues to push down. This is the perfect opportunity for an impulse entry in this scenario as well. Now, important thing. When are we expecting this to happen? Normally, whenever you have a scenario like this of an impulse entry, normally with a higher probability, you're looking at the second half of the candle to break this low. second half of the candle. Sometimes the first half of the candle also works. So let's say if you're looking at, if let's say this is a 30-minute time frame, maybe in the second 15-minute candle starts to break this low, right? So now I want you guys to follow me here, right? I want you guys to really follow me here and really understand, because let's say the next candle, it starts to make a top wick. This means that maybe the first 15-minute candle of this 30-minute time frame starts to make the top wick, or maybe it closes bullish, or maybe starts to go up. But as long as this high respected and the second 15-minute candle is high respected and the second 15-minute candle of the 30-minute starts to break the low, then you're like, okay, you know what? There's a high probability to continue down, because maybe that second half of the 30-minute may push the entire 30-minute candle all the way down, right? Or all the way bullish if we're looking at from a bullish perspective. This is the scenario that have worked over and over and over and over again. But the trick is to actually wait for this candle to form. The trick is to wait to see if the candle is really forming like the once the candle forms like this, the next waiting situation is that you have to wait for the next candle to break the low at this point. This is something that has worked. Now, we're going to talk about another scenario, and that scenario is going to be a little bit more risky. It's risky in terms of, because the trend is already bearish and the trend is already bullish, and you're really trying to catch that wave, right? What it looks like is like this. Let's say you have a bullish candle form like this, and you have another bullish candle form like this, and for example, we have a resistance at this point, and now all of a sudden, we have something bearish form, candles forming bearish, and then we're also forming some sort of a confusing candle, and then we have a candle that's starting to break the high of this previous candle. Now, this is where some risk comes in. For this opportunity to continue pushing up based on an impulse entry, it has a lower probability than the examples we talked about earlier. Okay? We have to understand this. This has a lower probability, even though you want to say that. So now this is where a lot of moves are missed, right? A lot of times you're waiting for the candle to close because that's the safest way. But essentially what you see is that candle starts to move up and it just continues to move up. And when it continues to move up, you're like, oh man, why didn't I enter impulse entry? It would have been so perfect. Now I've missed this entire move. It has gone up. There's no way to get this back, and yada, 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 yada. That's very normal. That happens, right? So now if you're somebody who gets stuck in these and you're not focusing on impulse entries, you're not trying to learn them, you're not trying to anticipate them, but you're missing trades, that's perfect. Because once the candle starts to break these highs here and here, you're looking at this and saying that, okay, you know what? If we broke above these highs, maybe, just maybe, I could have had an entry right over here as it broke this high right here. And my stop loss could have been below this candle. Because if we're breaking above this high, right, we're making a higher high at this point. There's a very high probability we're making a higher high. And at the same time, if we're making a higher high, then there's a higher probability we're also making a lower high, like a higher low at this point. Now, when does normally this happens? Normally this happens in high volume times, right? High volume times, market opens, market closes, we have news, we have breaking news on gold. We saw earlier on that price went up on gold about $30. 300 pips gold went up yesterday. This was the 7th November, so this may be recorded late. Anyway, whatever, right? So this is where you're trying to just watch to see where you could have entered. Now, again, as I said, this is riskier than the previous ones. This is way riskier. And I'm going to tell you the risk associated with this, right? Now, I know some people also have some questions, so we're going to go over those questions as well. Now, the risk associated with this is that even though if it's moving up, even though if it's breaking the highs right here, there's a very high probability it can just continue to fall back in this range, right? And this move up just becomes a candle that made a wick to the top hand side. That's the risk associated with this. So if you're someone who's willing to execute on something like this, you have to keep this risk in mind. If I'm going to execute on something like this, or if I'm going to execute on an opportunity which is presenting itself like this as it's breaking the high, and I'm trying to take a buy at this point, I'm keeping in mind that it can continue back in the range. So if the probability of it moving up higher is lower than the example we talked about in the beginning, I'm not using my full risk. I'm using half risk, or I'm using 3/4 risk, but I'm never using my full risk at this point. Never. At the same time, a more risky situation in this case could also be when you have a candle that just moves up without making a lower wick. A candle moves up without making a lower wick. That is extremely risky, because a regular anatomy of a candle is that a bullish candle is going to look like this. It's going to have a wick at the bottom. It's going to have a wick at the top. This is like something like a human with 2 arms and 2 legs. If a human has 1 arm and 2 legs, or like 1 leg and 2 arms, or no arms and no legs at all, then you're looking like, that's abnormal. That's, that's a bad example, but still, you know what I'm saying. So a candle here, if it has no wick at the bottom and it starts to push up here with volume, there's a chance that it can just continue to push down to probably make a lower wick. Who knows? It can continue to move down to make a lower wick. We don't know that. So once a candle moves up with no lower wick in the beginning, I'm staying out of it. I'm staying out of it because I want nothing to do with that. That's risky. That's not according to my plan. I'm not doing anything with that. Now, normally, what I would wait for, let's say you have a candle that closes bullish, right? Now, the size of this candle matters. The size of this candle matters. Let's say the size of this candle is, I'd say like 15 pips, right? Let's say the size of this candle is 15 pips. Then I'm going to be waiting for the next candle to probably make a lower wick. If the next candle makes a lower wick and starts to break the high, I'm going to be willing to take an impulse entry for candle to possibly continue up. And you all know where the stop is going to be, right? The stop is going to be below this current candle that breaks the high. That's what I'm going to be looking for. If the size of this candle is like 15 pips, like you have to gauge the size basically. But if, for example, right, and I've seen a lot of people make this mistake here as well. Let's say, for example, okay, let me just make this a little bit better. Let's say, for example, that the next candle is a big candle like this, right? And now the size of this candle becomes like, 30 pips, right? This is the size, it's 30 pips. It has a wick on the top. A lot of guys are going to do is they're going to say, okay, what? If the next candle, it makes a lower wick and breaks the high right over here, I'm going to take a buy, impulse entry, because Raja thought this, and Raja says this, and this. No. You're forgetting the fundamental rule of market structure. And the fundamental rule of market structure is that whenever we're breaking a zone, the further away price moves from a zone, the higher the probability for price to retrace. Okay? We have to keep in mind. So whenever we have a bigger candle forming outside of a zone, don't try to take a buy right here. It may go up. It may go up. If it goes up once, goes up twice, now you're going to believe that, okay, it's going to always go up. And that one time, if it doesn't go up, and instead of going up, it starts to let's say goes up, breaks the high, you take a buy, and it starts to go down, you're like, oh man, impulse entries are so tough, they don't work because of the fundamental rule that the price has left the zone. Once price leaves the zone, there's a higher probability for it to come down for a possible retest. And this retest we've talked about in market structure as well. So you have to wait for a retest. So whenever you have a big candle forming outside of a zone and you haven't taken an impulse entry here, you're waiting for price to come down, do a retest, and then continue to push up. Now, this is where I start anticipating the first example to happen. Remember we talked about the first example? This is where I start anticipating the first example to happen. Let's say the next candle goes down, but it closes bearish like this. Now we all know what we're expecting. We all know the higher probability of the next candle. We all know how the next candle is going to form. Next candle, there's a higher probability to break this high and continue to move up, and that's your impulse entry right there. So whenever you have a candle that breaks outside of a zone and goes to a lot of pips, just wait for this scenario. That's all that you got to do. Wait for this. Wait for something to print that you understand. Wait for something to print that you can look and say, okay, you know what? I understand this. I've seen this before, and I can execute on this with confidence. Right? That's what you're waiting for. Another thing. Now, all these things that we're talking about from a bullish perspective, and it's 100% accurate if price is forming a bearish structure for a bearish perspective as well. It's 100% the same thing right here. Now, if let's say we have a wick here to the left hand side, right? We have a wick here to the left hand side, and you have the perfect candle that's forming, and that candle, like, you know, it has made a lower wick, and you're like, okay, you know what? We've made a lower wick, and once this candle starts to break the high of this candle, you're like, oh yeah, you know what? I'm going to take an impulse entry, and once I take an impulse entry, price is going to go up. I want to make pips, blah, 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 blah. No. What you're missing is that previously this candle here was also bullish. It was also bullish, but for some reason, it got rejected. It got rejected and it came back in the range. So as this candle is breaking the high of the previous candle, there's a very high probability that it can move up, right? That it can move up, reject it, and make a wick like this. There's a very high probability that can happen. So you have to keep that in mind, right? What a better scenario would be for you to wait for a candle to close like this, to close in this area. What this will tell you is that previously we tried to break above this area, but we couldn't. The candle exhausted, went down in the range, rejected. But now we have this Robocop candle. I'm calling it a Robocop because something's strong, right? We're calling it a Robocop candle. Was so strong that it closed outside of that range. So when we closed outside of that range, and this is like, you know, 15 pips, not that big of a candle, and the next candle wicks down and breaks above this high, there's a high probability we're going to go up. That's all what I'm looking at in this scenario for impulse entries. Okay, so these examples. Now watch over this virtual class again. You have to go over this again, you know, and always keep specific, very specific formations in your mind. And they do happen, and when they happen and you execute on them, it's a beautiful thing. Trust me, it's a very, very, very beautiful thing. So always understand this, right? Impulse entries, the first time, you're not going to get them. The hardest thing about impulse entries is fearing of you missing the trade. Even if you miss the trade, that's totally fine. You don't have to chase the trade. You don't have to be in a trade just because you've opened up a chart and you got to be in a trade. No, you don't have to, because trading is a learning process, and impulse entries are extremely hard, right? Extremely hard. They're harder because you got to wait. They're harder because you have to wait for the candle to close. They're hard because you actually have to wait to see if the pattern is forming the thing that you recognize. Once you recognize a certain pattern that's printing on the charts, you're like, okay, like, you know what, automatically and naturally you're going to say, okay, you know what? I've seen this before, and I'm going to execute on this. And once you execute on this and you win the trade, you look on Instagram or Twitter or, like, you know, YouTube, and someone else took the same trade who you idolize or look up to, you're like, oh man, you know what? This is so easy. This is so easy. But impulse entries, they always start from you just sitting and watching, right? Sit and watch price play out. It slowly comes with experience, slowly comes with anticipation, and the more you anticipate certain things to happen, I promise you, the better you're going to get at that. Now, we have three, again I mentioned, we have three other sections in market fluidity about impulse entries, but this right here, what we discussed, was the perfect scenarios that I want to see and different scenarios that we've seen in the market. Now, some scenarios have a higher probability than the other ones. So normally, always adjust your risk. Always make sure the amount of risk you're going to take. Always make sure that the setup or the candle formation that you're executing on, it aligns with your risk management, right? So now I would prefer for you to go over this class again, maybe 2 or 3 times, make notes and understand what you really want to see in the markets. Take care. Okay, this is a very special section. This is also one of the most complicated. It's not complicated in terms of technical analysis, but it's more complicated when you're trying to manage your own emotions and your own psychology when it comes towards really executing these ideas. Now, this is called how to give your trades a second chance. So whenever we're talking about how to give our trade a second chance, the main concept here is that you have to keep your bias the same, right? The first step is to always keep your bias the same. Now a lot of times what traders would like to do is they would say that, okay, I'm going to take a buy at this position, and they take a buy and price does this, you know, weird liquidity grab, or it retraces more than you anticipated for it to retrace, and it hits your stop. Once it hits your stop, you're like, okay, you know what? I had a buy at this point. It hit my stop loss. I'm going to try to look for a sell. And once you try to look for a sell and you're selling, let's say your bias was correct, let's say your trend identification was correct, which was a buy. Now when you try to look for a sell, the trend continues and it continues up and hits your stop loss, and now you're lost 2 trades, right? And then maybe you try to take a buy after that and you get a small win, whatever, right? So now you have 2 losses. You took a buy, that didn't work out, and then you took a sell, that didn't work out, and then price eventually went exactly where you thought price was going to go. That has happened to a lot of people, and that used to happen to me as well. You know, now psychologically that's very, very damaging. You know, you lose confidence, it hurts your ego, or sometimes, you know, you're in a buy position and price retraces, hits your stop loss, and then it goes exactly where you thought it's going to go. That's very, very normal. You know, that happens all the time. Sometimes you can say, oh, well, even maybe I would have had my stop loss a little bit wider, or maybe, like, you know, like a lot of these things go into your mind. So the best thing to do at this point is to just step back and logically look at price, that, okay, if price did went into my favor, it went exactly where I thought it's going to go, how could I have executed on that, right? Like, what could I have done differently? Okay, maybe I could have looked for a second position, or maybe how could I have given my trade a second chance? And whenever you're looking at price in a way where you could have given your trade a second chance, there's always going to be a technical aspect to that, whether it's going to be a candle giving you a buy confirmation, or it's going to be a candle, you know, giving you an opportunity for an impulse entry, which we've covered in the past. You know, all those things are going to happen, and all those things are going to print exactly how you want them to print. Okay, so whenever you're looking at a trade and you're taking a loss on a trade, always understand this, that if price tends to go in your direction, there's always a way that you can give your trade a second chance, whether it's from a candle confirmation or it's that through an impulse entry. So we're going to go over some scenarios and some examples, and hopefully we can shed some more light on how to give your trades a second chance. So in these examples, we're going to assume that price is in a trend, which it should always be in a trend, and you're trying to trade the trend because trend is your friend, and we're not going to fight the trend. Okay, sometimes you may get opportunities to fight the trend, but just don't fight the trend, right? It's just not profitable. So we're going to go over some examples, and this is only going to be when price is trending. So we're going to take a look at a bullish trend, and if you reverse that, it becomes your bearish trend, and the ideas are normally basically simple. So let's take a look at this right here. For example, let's say we have candles pushing bullish, right? We have a bullish trend, candles are pushing up some more, and like, you know, candles push up some more at this point. And what's happening now is that now you're getting this sort of like resistance being formed up over here. Let's say you have some sort of a buy being formed. Now, just by looking at this, and trend is up, and I know some of you guys have gone through, you know, certain concepts and certain market structures and certain ideas. Do you think this is a great idea to take a sell at this point? Do you think? I don't think so. This is not a great idea to take a sell at this point, because for you to take a sell, so now this is basically all side note, right? For you to take a sell in a bullish trend, you want price to basically come down right here, maybe whatever, you know, and then you want price to create some sort of a support if you want to take a sell. This is side note. This is not related to this section where we're doing whatever. So you want price to create a support. Once we create a support, let's say this is also a 30-minute time frame. Let's say we've created a support. Now, if price breaks the support, this is where you should take a sell. Counter trend trading. We've went over this. This is when you should be taking a sell. Okay. Now, so we're not going to go into more detail on that. We've already went into detail with this, right? So what we're talking about is how to give your trade a second chance. Now, let's say price is continuing to push down. We are pushing down, you know, in an uptrend. We're making a higher low, and this is where we have created a support now, right? We've created a support, and price is pushing up. And let's say, for example, this is a 40 pip range. You have a 40 pip range, and you're saying that, okay, you know what, there's a high probability for price to go up, and you're looking at some sort of a confirmation, and this is your confirmation where the candle has closed bullish. Let's make this a little bit smaller, right? Candle has closed bullish. Everything aligns in your favor. 30-minute time frame, bullish trend, support formed, higher low formed, and there's a high probability for price to continue to push up, right? And that's where you're executing your perfect buy. Now, for example, let's say that price does not do what you anticipated it to do, and instead of moving up, let's say price wicked down, it broke above this high. Let me remove this. It broke above this previous high, and then price started to continue pushing down, right? And we formed a bearish candle at this point. What are you going to do at this point, right? We formed a bearish candle. Now, this is only provided that now, here's the thing. Whenever you're looking for a buy or a sell, you're keeping the same bias. I cannot stress this enough. You're always keeping the same bias. If you're looking for a sell, you have a selling bias only if price is trending bullish, right? If price is trending bullish and you're only looking for a counter trend sell, you're waiting for the support to break and then you're taking a sell, right? If price is trending, let's say bearish, then you're looking for sells or whatever. But if price is trending bullish and you're only looking for buys, you're only looking for buys. Never change your buys for anything. Never. This is the core value of trading right here. Never change your bias. Changing bias is only left for experienced traders who've seen certain things happen over and over again. So never, ever, ever change your bias. This is the pro tip right here. Never change your bias. Now, let's say, for example, you took a buy and you took a loss at this point and candle closed like this, right? Now you're like, oh man, you know what? I expected price to go up. It didn't go up. Like, what should I do now? The best thing to do at this point is to just wait to see if you have another buying opportunity, how to give your trade a second chance. Now, this may for some look like, oh, we can go down, blah, blah, blah. But let's say, for example, if we do go down, we go down, and your bias was bullish, so your buying opportunity never came, so you ended the trade in a loss. Now, let's say, for example, you were able to manage risk, so you didn't lose the whole percentage, you lost a portion of that risk, and that's it, right? Loss is a part of the game, you manage your risk, you lost less than what you anticipated to lose, perfect, day closed, awesome, right? Now, for example, instead of moving down, we have a candle that goes bullish. Now, this is very, very, very important. Let's say you have a candle that goes bullish. Now, there are two scenarios, right? There are two scenarios that this happens. Now, if we focus on just this idea right here, don't you think that we have a bullish candle and then we have a bearish candle right here? So we have a resistance form. Now, note this down. If a candle closes bullish, but it's still below this resistance that we formed, this is not a good opportunity to buy, because we're still under this resistance. Now there are different scenarios that we're going to go over, right? So we have to keep making notes, right? If this is a resistance, we're closing below this resistance, this is not a good opportunity to take a buy. The best opportunity to take a buy would be, number one, if this candle closes above this resistance, and now you can give your trade a second chance. Now you can give your buy a second chance, anticipating the next candle to wick down and to continue pushing up, right? So, okay, so over here we have some confirmations. The first confirmation is that you have a bullish trend. The second confirmation is that we have formed support. The third confirmation is that the candle is closing above this resistance, which is now giving you enough probability for price to continue moving up. Now, another thing, side note, when are big moves supposed to happen? When can you expect big moves to happen? Can anyone answer that to me? Can anyone? There's no one here, it's only me. And you guys watching. Okay, so big moves only happen when there's volume in the market, right? And when do we have volume in the market? We have volume in the market, you have pre-London session, you have London Open, you have pre-New York, you have New York Open, you have NYSE Open, you have London close, you have news happening, you have breaking events, and all these times when there's volume in the market, right? That's the only way when you're gonna have a big candle forming. Now, right, first, situation, candle closed above resistance, now you have a very good opportunity to price to go up. Now understand this is a wick, this is a big wick right here. We can form all sorts of candles, all sorts of things can form, you know, and this is a big wick. Whenever you have a big wick, we've talked about this in impulse entries, you can't take an impulse entry, because if you're waiting for this candle to break above this high, then your entry is going to be too late. And sometimes it's going to happen. Sometimes what's going to happen is that you're going to have this candle just move up, break above this high, and then continue to go up. Okay? Now, was there an opportunity over here for you to give your trade a second chance? Your trade has to make sense, right? Logically, market structure, the way the candles are printing, they have to make sense. It's not all the time that you're going to have an opportunity to give your trade a second chance. It's not going to happen all the time. Sometimes it's going to happen. Well, I would say most times it's going to happen. I'd say maybe, you know, the probability, maybe 80% of the time, you're going to have an option to give your trade a second chance. The 20% of the time, you're not going to have an opportunity to give your trade a second chance. So this is when you're gonna not have an opportunity to give your trade a second chance, because as we mentioned earlier, if this is a 40 pip range and now price has broken above this area, is this a good idea to take a buy at this point? Right? What did we learn in the previous sections? Is this a good idea when price is in the middle of a range? It's not. You know, a better idea would be for price to maybe be closer to this zone so that there's a high probability for it to continue pushing up. This is a situation where it may not work, and I really hope you guys are taking notes. Okay? Now, for example, let's say this wick right here, it was this big. You know, it wasn't that big of a wick. You know, it was this big wick. And if the next candle starts to break above this high to the left hand side, you can take an impulse entry. Because if we're now breaking above this high, we learned in impulse entries that this is now a really good probability for price to continue pushing up. Okay? This is a really good probability for price to continue pushing up. This is where you can give your trade a second chance. Second chance is that you give the first chance right here. After this confirmation, didn't work, you got stopped out, and now you're waiting for price to break above this high, and now you're giving your trade a second chance. Now, when you're talking about risk, let's say you're only giving your trade a second chance if you still have risk left in your day. That's why managing risk is really, really, really important. Let's say your total risk for the day was 2%, and you took a trade right here. Let's say you put like 1% risk there, and you manage risk. Instead of losing 1%, you lost 0.8 so you still have 1.2% risk left. And now you're using, now it's up to you whether you want to use the full 1.2% risk or you want to use, let's say 1%, 0.5, whatever. That's totally up to you. But in essence, this is where you're giving a trade a second chance. And this also means that you're taking a second trade. Essentially, it's just a second trade. You know, your first try didn't work out, so now you waited for your second confirmation to show up and you tried to give your trade a second chance. Okay, this only happens when price is trending. This only happens when there's volume in the market, right? So there are different situations, there are different ways that the candles can print and can give you these ideas that this may work in your favor. Okay, so we have to keep these things in mind. Giving your trade a second chance is a complicated idea. It takes a lot of practice. It takes a lot of sitting around and watching what price is doing, because here's the thing. Whenever you're going to take a trade, and in your eyes and in your mind, it's going to be a perfect trade, a perfect opportunity to execute. And if price doesn't work that way, all these emotions come in. All these emotions, you're thinking that, oh man, shit, I took a losing trade. Let me take a sell. Let me take a sell over here and win this trade because it's going down. No, keep the bias the same. Just relax. Calm down. And the first way to calm down is to manage risk. If you know, if you know that you have managed risk, if you know that you risked $100 and you've lost, let's say, $80 and $70 trying to take a buy, now you're perfectly fine. You're like, okay, you know what? I managed risk and I'm a mature, confident trader. I'm going to sit back and I'm going to see if price gives me a second chance for it to continue pushing up or not. Okay? And this is where these situations are where you can give price a second chance for it to continue pushing up. Okay, now there's another situation that happens, and we're going to talk about that as well. There's another situation that happens that, let's say for example, we have support formed. We have support formed, and the next candle, you know, it forms and it breaks the high. You're like, okay, perfect, we've broken the high, now we're going to go up. But instead it starts to break down. It breaks the low right here, and it still closes bullish. Okay, so we have a bullish candle closing. Let me make this a little bit better. That's not a bullish candle, that's a weird looking bullish candle. We have a bullish candle closing like this, right? We have a bullish candle closing like this, and you're like, oh man, you know what, I had a buy at this point, price broke the high, I took a trade and price came down, my stop loss was right here, and it hits a stop loss, and now I have a loss right here. And while you're crying about that loss, you see the next candle wicks down and continues to push up. And you're like, oh man, shit, like if it didn't have hit my stop loss, I would have had a profitable trade. Now, just at this moment, a lot of you guys are thinking the same thing that I'm thinking, that okay, if you took a loss right here, and if you managed risk, and also remember, there's always a probability you're going to be able to manage risk. You're not going to be able to manage risk all the time. You're going to be able to manage the risk most of the time. And sometimes you're going to take the full risk on the chin, and that's totally fine to solve our probabilities. Now, you're thinking at this point is that, okay, maybe if this candle broke above this high, we could have taken an impulse entry and given that trade a second chance. And that exactly what we thought it was going to do, because now we gave a trade a second chance and we made some money, or we reduced some of the loss we had over here, or like, you know, we put the risk that was left from this trade over to this trade, and now it basically worked out. Okay, so these are different scenarios, different things that can happen, and these are things that you notice in the market as you're trading them, because as you're sitting back and watching how price is moving, you're looking at candles, you're looking at the different way the candles are printing, and you're kind of like visualizing where you can see the next candle move, where you can see the next candle go. And once you start to do this for like, you know, 3 months, 4 months, you start to have an intuition, is what I call, right? This intuition comes over time. Like after watching all we've done over here, you're not going to be able to do like, you know, or to give your trade a second chance maybe by tomorrow or next week or the week after that. It's going to take you like maybe 1 month or 2 months to just kind of like really absorb the information and keep watching how the candles are printing, and then you're going to be able to successfully give your trade a second chance. But listen, in the beginning, I wouldn't recommend for you to just jump in giving a trade a second chance, right? Take those losses, but manage your losses. And once price does something that we've discussed here, just take like a mental trade. Take like a mental trade and watch it. And don't take that mental trade stressing about, oh, I could have been in this trade. That's totally fine. That's totally fine because you're still learning, you're still progressing, you're still adding these tools to your trading arsenal for you to be in profits in future, right? So this is all a mental investment that you're doing in yourself. So later on, once these situations happen, you're going to be able to execute on these, and someone new is going to look at you and say, oh, hey, man, how are you able to do that? And you're going to say, oh, well, you know, it's easy. Just give your trade a second chance. And they're going to say, oh, how? You know, so these situations can also happen. Now, there's another situation that happens all the time is when, you know, the next candle breaks below the low and just continues to push up. You know, these scenarios are where you can't really give your trade a second chance because there was no confirmation. And always remember, whenever you're giving a trade a second chance, there needs to be a confirmation. There needs to be a logical way where you can execute that trade. Okay? Very, very important. Giving your trades a second chance. And also rewatch this, right? The rules were you have to have the same bias. Don't change your bias. Changing your bias is going to be very, very risky. It's going to be detrimental to your mental health. It's going to be detrimental to your trading psychology as well. Never change your bias. I have a lot of people who can successfully give their trades a second chance. So there are different scenarios that we discussed over here. So what we're going to do now is we will go over how to add risk back to your trade. So we're going to go over that. How to add risk back to your trades. Give their trades a second chance. So there are different scenarios that we discussed over here. So what we're going to do now is we will go over how to add risk back to your trade. So we're going to go over that. How to add risk back to your trades. Let's take a look at this right here. Now, this basically fits in perfectly with giving your trade a second chance. So we're going to talk about that, how to add risk back. Now, whenever we're talking about how to add risk back, it's basically after we've basically managed risk, and when price starts to go back in our favor, that's when we're saying that, okay, we're going to add risk back to the trade now. So let's take a look at this. All right, so in this case, so we're going to talk about, so we're going to go over some, like a bearish trend. Let's say we have a bearish trend, price is coming down, you know, you have a bearish candle, and then over here as well, you have a bearish candle coming down, we have another bearish candle, move down, another bearish candle, move down, and then we have a bullish candle forming, we start to go up, we've created a, let's say, a hypothetical support. We have another bullish candle that goes up, and that's basically it, right? And then we have a bearish candle forming. Boom, resistance formed, trend is down, you're anticipating the price to go down. You're basically, this is, let's say, a 40 pip range, and you're anticipating price to continue pushing down. Now, all of these scenarios, they do happen when price is trending, right? So in this case, price is trending bearish, and this is what we're going to go over. So let's say you take a sell, and instead of pushing down, price starts to go up. Now, the most important thing here is for you to really understand how managing risk works, right? And that's what we've explained in the risk management section, the third one, and also in the risk management 3.0 in market fluidity. So you have to go over that first, okay? You have to go over that first. Now, for example, let's say we're looking at the 30-minute time frame, right? We're looking at the 30-minute time frame, and let's say all the 15-minute candles are also bearish. So let's say this 30-minute candle consists of two 15-minute candles, which are basically, you know, like this. You got two 15-minute candles that are basically like this. You take a sell at this point. You've taken a sell, and price wicks up. When price is wicking up, and in this on 15-minute, let's say price is wicking up and moving up, once it starts to break the high of the previous 15-minute candle, you're like, oh, okay, wait a minute. We're breaking the high. Maybe at this point, if we, now, two scenarios, right? One, if we close bullish, I have to manage risk. Or if it breaks the high, I have to manage risk. So you're managing risk. You're closing 50%, right? You close 50% risk right there. Let's say you had a one lot. You're closing 0.5. So now you have 0.5 left open. You have 0.5 left open. You're like, okay, you know what? I don't know. I don't understand whether the price is going to continue to push down. It's going to push up. So either way, you managed risk and you closed 50%. Once you've closed 50%, now you're waiting to see how price is really going to move, right? So let me remove these lines over here because we're going to be using this as well, right? So let's say now the 30-minute candle, it starts to close bearish. And what it looks like over here is that the 15-minute candle, it starts to push on, moving down. Now we've closed bearish here on the 15-minute. And as you can see now, we've created a minor support on the 15-minute, okay? We've created a minor support on the 15-minute, and also the 30-minute candle is moving down here a little bit too. So when we're moving down in the scenario, now you can look around and say, okay, hey, wait a minute. I still have, let's say, a 0.5 lot running, and if the next 15-minute candle breaks the low of the previous one, maybe I can add the risk that I closed. So in this case here, you can add your 0.5 lot back, you know, and your stop is either going to be, it can be above the 15-minute candle, or like, you know, it can be above the current 15-minute candle that's just forming and breaking below the low. Now, there are a lot of things that can happen here, right? This 15-minute candle, you need to have volume to push price down. And this 15-minute candle can just move down without making a top wick in the first minute, first 5 minutes, 3 minutes, 4 minutes. So that's all on your intuition. That's all on your judgment, how you're going to perceive that. But this right here, we're talking about the fact that once we've made a top wick and we've broken the low, that's the perfect scenario to add risk back to your position. As we start to break the low, you can add position back. You're like, okay, you know what? I'm going to add it back. And on 30-minute, it looks like price starts to go down. Okay? But the most important thing is that you are managing risk. You're actively managing risk. And once price starts to form in your favor, you're adding that risk back. So that's how it works. And there are also various variations to this. Number one variation is that if, let's say, for example, let's say the 15-minute candle broke above the previous high, and the new 15-minute candle, when it forms, it just starts to drop down. You know, once it starts to drop down on the 30-minute, it kind of looks like this. Okay? When this happens, there's basically no way for you to add risk back. If you look at this, right? Because the 15-minute candle, you know, this broke above the high, you manage risk. Next 15-minute candle broke below the low, and it moved so quickly, you're like, oh man, I couldn't manage risk, so I took the trade, whatever I could take. You know, that's why sometimes you can see if you're going to have a one lot and price moves, let's say 100 pips, and you've managed risk here, you, instead of making $100, you make like 50 bucks because you let the 0.5 run till, you know, 10 pips or whatever. But some people are more advanced. Some people are more, you know, experienced. So what they're going to do is they're going to say, okay, you know what? If the 15-minute candle is breaking below this low, and 15-minute candle breaking below this low also means that the 30-minute is breaking below its own low as it starts to go down. That means with volume, there's a higher probability we can continue to push down, and that's where they can probably take an impulse entry to say that, okay, we wicked up, I managed my risk, now we're breaking below this minor support, impulse entry would make sense, so I can add risk back to this trade for price to continue pushing down. Make sense? So you have to re-watch this again. You have to go over this. You have to look at examples. The best thing to do is to look at all the losses you've had in the past, all the losses, and look at those trades and then really ask yourself that, okay, if I took a loss in this scenario, where could I have given my trade a second chance? What could I have done differently so I could have given my trade a second chance? Or there are also multiple scenarios where you managed risk and price still went in your favor. Now, sometimes people over-manage risk, right? Over-managing risk is that you're going to basically close 50% right here, and then next time it goes up, you're going to close another 50%, another 50%, and before you know it, you only have like 10% running, and 10% that runs, that profit sometimes isn't enough to cover the loss you had closing in negative, okay? So over-managing risk, don't do that. If you're going to over-manage risk, do it only twice. Close 50% once, then close 50% twice. That's it. Don't close more than 2 times. Because if price is going to go in your favor, it's going to go in your favor after that one time you manage risk. If it's going to go in your favor. If you manage risk the second time and it still doesn't go in your favor, just close the whole position. There's no need for that. Because if price then goes in your favor later on, you can give your trade a second chance. Make sense? Right? It's all logic. So, go over this virtual class right here. Go over these classes. There are different scenarios that happen. And also remember, adding risk back to the trade and giving your trade a second chance. They go hand in hand. They are very, very similar. They're very, very similar ideas. Giving your trade a second chance and adding risk back to the trade. They are very similar ideas, and you have to wait for candles to print exactly how you want to see them printed. Now, for example, some things can also happen like this. Let's take a look at this right here together. Sometimes what can happen is that candle is closing bearish, and you're like, okay, candle closing bearish, I'm going to take a sell over here. You take a sell here, and what happens is that next candle, it breaks above the high of the previous candle, right? You get stopped out, and then the candle forms like this, a weak bullish candle. A candle forms like this after you get stopped out. After you got stopped out, and we're still in a bearish trend, and we're still closing below this resistance. Remember, this is a resistance, right? If we're closing below this area, now you know what's the high probability. The high probability is if the next candle wicks up and it breaks below the low of this candle, we all know what's going to happen. There's a high probability with volume we can continue to push down. And that's where you can give your trade a second chance as well. Right? Impulse entry. Most of the time, impulse entries are great to give your trade a second chance, adding risk back to the trade, and so on and so forth. Okay, but the main thing is you have to wait for candles to print exactly how you want them to print. That's very, very important, because you have to see the exact scenario and then you have to execute on this. Because remember, guys, you're trading with money, and this is real money. You can't play around with your money. You have to wait for candles to print exactly how you want them to print. Sometimes, we can look at the candle and say, oh, I have a feeling it's going to move a certain way. Or I have a feeling it can go in a certain direction, so let me just take that trade. Low risk trade, but let me take that trade. But once that trade doesn't work out, your ego's hurt, your confidence is hurt, and things basically go downhill psychologically from that point. So you have to always wait for candles to print exactly how you want them to print. All right, again, remember, giving a trade a second chance and adding risk back to the trade, they go hand in hand. They work together, okay? Whenever you take a loss or whenever you manage risk and you're like, okay, you know what? I've managed risk. Now I'm ready to, accept the risk that I've taken in the beginning, and the price doesn't stop you out and starts to go in your favor. You're looking at different scenarios to see that, okay, does this make sense where I can give my trade a second chance? Because remember, it has to make sense, right? Whenever you're giving a trade a second chance, or whenever you're adding risk back to the trade or a potential move, it needs to make sense from a technical perspective. Also from market structure, it has to form in a way that you recognize that it does work. Now, again, as I mentioned, it does take time. It's not going to happen overnight. You're not going to get really good at it maybe in the next week. Man, I'm not even perfect at it. I'm still sometimes, when price goes in my favor, I'm still kind of hesitant to maybe give it a second chance, but I still do. Most times when I still do, it does go in my favor. Sometimes it doesn't. That's the probability of trading. So you have to give it a chance. You have to just watch how price moves. Whenever you take a loss, step back. relax. If you managed risk, be happy about it, because a managed risk trade is a winning trade because you lost less than what you planned on losing. Now, go over these things, go over the section again, and look at your losses. Look at the trades where you closed early. Now, sometimes guys ask, hey man, listen, like I closed my trade early, what could I have done? And the answer is very, very simple. Whenever you think you should be closing your trade early, close, let's say 90%, or close like 50%, whatever, right? We've discussed that as well. So take care, everyone. Go over this section and always go over your losses, and you're going to be surprised how many things you can find in them. Take care.